Now, one of the main themes that we've had is this chart. It's the dollar index. Now, this is a monthly chart, as we can see. If we look right the way back to 95, there was this big rally that took us up to just after, well, year 2000, 2001. And, you know, those of us who were actively trading at that time will know that that was when the tech boom in the States really took off. And of course, it was sucking in an awful lot of worldwide money to participate in that boom. And then, of course, we get the crash, and the whole thing just evaporated. It was froth. It was all sort of hot air. The tech boom, and what did we find was that the stupid valuations that were put on so many of these companies that just sort of had internet or sort of tech or programming in their title, it was found that a lot of these companies were indeed just worthless. They were paper shells. And of course, we then get the collapse that ran on down with the culmination of the disaster that befell the world with the crazy situation with CDSs, credit default swaps, etc., based on anything that moves, based on any amount of debt, any crazy bit of debt that could be then packaged up very neatly and sold off to banks. And as we know, the whole thing just collapsed in a big way. Now, that did give, as we can see, it did give a temporary move with a panic into the US dollar, being a strong currency and also, of course, the safe haven of US treasuries, bonds, etc. Since then, the dollar has gone absolutely nowhere, and we've got this period now, or at least we have had this period of a beautiful triangle setting itself up. Now, triangles eventually will reach an apex, and they tend to get tighter and tighter and tighter, and as we can see, we eventually will get a breakout. Now, the breakout we've seen has given it quite a dramatic move on up. And if we look at the distance that this has traveled so far, and if we just put this in big round numbers, we've got 80 to 90. And we can see that previously the boom that went, the boom in the US dollar that went from 95, which lasted, okay, the best part of sort of 5.5 years or so, actually went from 80, much the same level that it actually started off on the current boom, and it went all the way up to 120. Well, is it likely to do that again? Well, it could happen. Is it likely to move into a halfway house, which is in this region of 100? Yeah, you know, one imagines that that is highly likely that it will actually do that. Now, we've just had this boom going on now, and we've had this going on for about 7 months. So what about previous 7-month runs? If we look back over here, then we can see quite a number of runs, but generally, in fact, we've got quite a reasonable one just here. 1, 2, 3, 4, 5, 6, 7, and then there was going to be a correction. So if we just suggest that this current uptrend is going to follow previous dramatic uptrends, then the prospect of 7 solid months, higher after high after high after high, it suggests that we are going to get a correction at some point, and that correction could possibly be imminent. Now, there's a saying in the on technicals that when price starts to move up to a previous high, then that's the most likely place that we're going to get a pause coming in. And so that's exactly, well, I say exactly, it's in the region. We'd better put another line across just to pick out the high. So we've got a nice little region where we are most likely to get some form of a correction, because we've got previous resistance here. We've got two lumps of previous resistance, and we've actually also got a support area going right the way back to 98. So are we looking forward to a move that should just carry on up? Should we wade into the US dollar right now, and expect this to move right the way up to 100? Well, I think we've probably got to be a little bit cautious because we have had a big run. And based on what I've just been mentioning, then we are highly likely to get a correction coming in. Now, trends run and they can keep on running for a period of time. But we've always got to keep in mind that when there is most optimism about, when most people are talking about a particular market carrying on forevermore, then that's exactly the time that people will be selling into strength, because there will be a lot of traders, hedge funds, banks, etc. out there who have done exceedingly well out of this rally and will be sitting on massive paper profits and could just be ready to go and take some of those paper profits. So that's the backdrop then of the dollar index, and let's just look at the other side of this coin, which is the euro. Now the euro has been doing more or less what that dollar index has been doing, but of course it's an upside downer. We've got this upside down chart where we're looking now at a breakout of this entire move. Again, let's just use a line where price currently is. And what we can see is that we've had something of a breakout, but there is still a low from where it needs to break. Now it's dropped down below that emotive level of 120, and ultimately we may well find that it's going to break through this next band of strong resistance and come right the way down to parity, right the way down to 1-to-1 with the US dollar. And of course, what's fueling all of this at the moment? Well, on the dollar side of the coin, we're seeing that the US economy is actually recovering at a greater rate than other world economies, most notably the Eurozone, which is struggling like crazy. And if we just sort of look back in history, what is Europe made up of? Well, it's made up of Germany, the powerhouse of Europe, and pretty well every other constituent member of the Eurozone traditionally have struggled to maintain reasonable growth. They always have. I mean, it's going back decades, absolutely decades. So if you then get a situation where Germany, for all sorts of reasons, is starting to struggle, then consequently we're finding then that the euro as a whole is on a bit of a sticky wicket. And we may well find that just purely based on relative economics, then the euro should be destined for much lower levels. Now, all of that said, there are umpteen other factors coming into play, and one of the main ones is Mario Draghi's suggestion that there is going to be more and more and more QE, or a variation on QE, with more sovereign bond purchases, etc., in order to pump more money into the banking system. And there are those who just might hope that it's actually going to get down into the real economy. That is, in workers' pockets and in their pay packets, so they can spend more and get the growth thing going again.